All right, so welcome back, guys. It's been a long time since we did a lecture, so let's go ahead and get started. So chapter 13 is going to be all about the closing process. Now, this is going to be the part of the last section in the accounting cycle. So throughout this entire time, we've been doing the class project, right? Coffee Cafe. We recognize the first 4 steps. Yes, we have completed step number 5 occasionally, but this one's going to, step 5 is actually a different trial balance, okay? So throughout this entire time, we've been doing steps 1 through 4, right? We recognize the transaction, we analyze it and we sort it, we journalize it, then we post it to our ledger. And that's what I've been teaching you so far. So now this section here is going to be talking about the last remaining 6 steps of the accounting cycle. So we're going to look at properly doing an unadjusted trial balance, creating our adjustment entries. We're going to also create an adjusted trial balance, so there's a difference. And then we're going to create our financial statements and then close our books out for the given period, okay? So, of course, step number 5 is to complete the unadjusted trial balance, okay? So, for our company, Coffee Cafe, we've only done so far up to the 28th, okay? My potential goal is that we are planning to complete the accounting cycle at the end of every month. So we still have to do the 29th and the 30th of June, okay? And with that being said, this is the trial balance that happens at the end of a given period, okay? So that means at the end of the month is when we're going to complete our trial balance. So in this case, so what we've been doing throughout this entire time was just regular trial balances to keep our account, to ensure that that when we do our accounting, that we're keeping a good track record of our debits and credits. Now, especially when we do our trial balance, we do it every week just to ensure that we haven't made any mistakes along the way. Now, depending on your company, whether you should do it as often, it will depend on how many transactions you actually complete in your company. So in this case, you never really want to wait till the very end of the period to complete your trial balance, because you could have made your mistake either at the very, very beginning of your period, or you could have made a mistake in the middle or even at the very end. So your accounting is very important, especially completing the trial balance. So once we've completed everything and we're ready to close our books, this is where we complete the unadjusted trial balance. So as you can see, our goal is to make sure that our debits and credits match, okay? And then once we've got that okay, then we can go ahead and move on to step number 6, which is to complete your adjusting entries, okay? So what is an adjustment entry? It's anything that you record typically at the end of a given period. So a good example is if you buy, office supplies or any kind of business supplies, right? When you buy it, you have a given quantity. At the end of the month, you're going to calculate to see how much of that quantity do you still have left at the end of the day, because throughout the whole month or the whole period, right, you've already used the items. And that's what an expense could be determined as, whether you use the product. So again, for our business, right, we have cost of materials, okay? That one, you could have made an executive decision to either cost it as business supplies expense, or you can actually cost it as cost of material, right? But we did also buy office supplies, right? We bought some office supplies. So our assumption is that we will be using the office supplies, and we need to make an adjustment to our books to report how much supplies we actually have left. Okay? Another adjusting entry is periodic inventory. So remember, we talked about this before in chapter 5. Now it's coming all together. When you reach the end of the period where you need to physically take a physical count of how much inventory you have left, that is where you're going to complete your conversion entry. Okay? Other adjustments that we've talked about too is going to be depreciation, our bad debt expense, and our amortization, right? For those kind of things, right? When we need to make an adjustment. So now it makes sense that when I ask you, is this a contra account or an adjustment entry? Now this is where it's coming together, because now we're reached the end of the period. Now this is where you actually do your adjusting entries versus your contra accounts, okay? Once you've done that and you've journalized it, so here we have to journalize it and make our adjustments. So we have an office supplies expense, and we're taking it directly out of your office supplies, okay? Same thing with depreciation. You're going to take it directly out of your accumulated depreciation, okay? So once you've completed those journals, right, adjustment journals, you're going to complete now the adjusted trial balance. Now notice this mentality or this sequence is every time you touch your journal or you enter in a transaction in your journal, right? The next step is to post it to your ledger, and then the next step is to complete the trial balance. This is going to be rinse and repeat until you ensure that you didn't make any mistake along the way. So the first section was completing the whole transaction for the whole entire month. Check. Now this is completing our adjustment entries. Check. Now after you've done that, you're going to do your closing entries. Then you gotta double check to make sure that all of your numbers have matched, completing another trial balance. So again, this part is the tedious part, but this is the part where everything starts piecing and coming in together. So again, once we've completed our adjustment entries, we need to make sure that we properly took out the debits and credits and placed them in the correct account. So we're going to test again to see if our debits and our credits match. Once we get the good okay for doing the adjusted trial balance, next step is going to be the financial statements. So again, this is going to be a partial review from chapter 1, because now we're going to be actually completing the 4 financial statements. All right? The very first one is going to be the income statement. These must go in a specific order. You need to complete the income statement first, then your statement of equity, then your balance sheet, and then you can do your statement of cash flows, okay? So the first one here is your is your income statement, also known as your profit and loss. All right? Now, how we determine whether the company made a profit or a loss. Pretty straightforward. You're going to tally up all of your total revenues, okay? Or in this case, your main operating revenues. So for this specific, scenario, we're applying everything that was involved with our sales, okay? Things that you would counter against it will be your cost of goods sold and your cost of material to get you a gross profit, okay? Once you get your gross profit, you're going to subtract every single operating expense that it took you to incur to run your business. All right? Then the last section here is to enter in any other income, okay, because that's not part of your operating, it's separate. And then you're going to determine from there whether you have a profit or loss. Now, when we talk about income tax, this is more for corporations because you get taxed twice, right? You get taxed at the corporate level and you get taxed at the income level. So in this case, the income tax for this particular scenario does not apply, but it is something you should know if you are going to be working on this kind of statement for, a much bigger company, all right? But for sole proprietors, you are actually excluded from including the income tax, okay? But that's how you determine the profit or loss. Obviously, if you have a positive number, you got a profit. If you have a negative number, you have a loss, okay? And the one thing that sole proprietors can do is they can either have the choice to either reinvest into their own company or they can choose to pocket the profit or not, okay? So again, you're going to total up all your sales, subtract your cost of goods sold and cost of material to get your gross profit, subtract all of your operating expense, add any other income to determine your total amount of either income or loss, okay? So again, you need to complete that because if you choose to reinvest in your company, then that's what the statement of equity is actually going to entail, all right? If you have a net income and you choose to reinvest into your company, then you're choosing to increase the value of your company, okay? If you choose to pocket it, then obviously you don't take it, right? You don't record it. What you're going to do is, you don't record your net profit because you're going to pocket it, okay? Now, you do need to show that if you are going to do that, you're going to have to record the net profit regardless and just take it out as an owner's withdrawal. Okay, that's the proper way to make sure that you're not frauding the company is to properly journalize that. But in this case, rule of thumb, generally you should reinvest in your company, especially if you're a small company. Okay? Now, if you have a net loss, you are mandated to record this into your equity because, again, you're going to have to record a loss regardless whether your company is looking good or not. So you want to make sure you adjust your value of your company. So that's the first thing that you're going to do. You're going to recognize the beginning balance of your equity. Then the second thing you're going to do is if you choose to reinvest into your company, then you're going to record your net income. Other factors that contribute or, change equity is obviously going to be any capital contribution. So if you reinvest your own money into your company, then that's going to increase your equity. And things that will decrease your equity is going to be your owner's withdrawal. So once we've listed that, then we can determine how much your company has been increased by in equity. Okay? So then here in this chart here, you have a beginning equity and then you have an ending equity as of the end of the month. All right? Now, once we've done that, the next step is to complete your trial balance. Okay? You already are given your new equity. So you can take that equity and place it into your the equity portion of your balance sheet. Okay? So again, your balance sheet asks and answers that one question, right? It applies the accounting equation. It asks, well, does your total asset equal your liabilities plus your equity? So in this case, we're going to have to solve to see if our total assets reflect our total amount of liabilities and our equity. So again, we'll be given our new piece of equity. So you plug that in here, and all you're really doing is tallying up your total assets and tallying up your total liabilities. And if they match, or if the statement is true, then we can go ahead and move on to the next portion. Okay? So once we've done that, then the next one is going to be the statement of cash flows. So statement of cash flows, it can be a tricky deal if you're not quite sure how to complete this. Now, with this particular company, what we're doing is we're essentially going from an accrual basis and converting it into a cash basis, right? The whole purpose of creating the statement of cash flows is to actually determine how much actual money is flowing into the company versus how much money is actually flowing out of the company. So any accounts that's going to be considered an accrual account. So for example, right, we have cash sales and we have accounts receivable sales. How much of that is actually cash? Like, did you actually receive cash for? So in this case, we're going to learn that we're going to be converting our accrual accounts and converting them into cash. So for example, when we talk about completing this, I'll go through it each and every single one. An accounts payable. Do you actually have the cash for that? In this case, no. So what you're going to do is you're going to subtract that money because you actually don't have it. For your accounts payable, did you actually make the payments already? Of course not. So what you're going to do is you're going to add that back into your cash flow because you haven't paid them yet. So again, accounts receivable and accounts payable, they're kind of looked upon as an accrual account because it's not cash. It's an IOU, right? It's a representation of some form of cash, but it really isn't there, okay? So that's what we're going to be doing here. And how the statement of cash flows is categorized is by three activities. You have your operating activities, okay, which primarily will involve your current assets and your other assets as well as your current liabilities. Then you have your investing activities, which is more along the lines of your fixed assets. And then lastly is going to be your financing activities. So typically that's going to deal with either your long-term liabilities and your equity. So again, we'll pull those things in there. And at the very, very, very top is obviously going to be your net income because this is going to be consisting of your actual sales that you've collected with both cash and accrual concepts, right? These are both cash sales and non-cash sales, right? So we need to reflect that as the first thing, right? And then what's going to happen is at the very bottom of your statement of cash flows, you're going to have a beginning balance of what you started your company with, and you're going to be, it should match your total ending balance that you should have in your checking account. So that is how you verify and make sure that the statement of cash flows actually pans out and works, okay? Is that the ending notes that you should have is your beginning balance matches as well as your ending balance matches, okay? And that's the statement of cash flows. Then goes to step number 9. Step number 9 is going to be actually closing out the books. Now, how we close out our books is, we talked about this as well in chapter 2, is that you have your temporary accounts and you have your permanent accounts. Your permanent accounts never close out at the end of a given period. So a perfect example of a permanent account is your checking account. If you close your checking account, that is automatically assumed that you're no longer doing business and that you're shutting down your account. So if you close your checking account for the reasons, it's assuming that you stopped doing business. So you should never, ever, ever close out your permanent accounts. However, we also learned that our temporary accounts do close out at the end of the period because it gives us a a nice steady flow of profitability, right? Your revenues, right? When you earn your sales and earn your income, it's going to reflect various different numbers, right? Your revenues will not be the same every single month. It's not going to be reoccurring. It's always going to be different every month or every week, every day. So that's why we choose to close out our revenues and our expenses, right? Because your expenses also follows the same concept. There are times where your expenses that you incur are never going to be the same every month, unless it's a fixed expense, which is rent, of course. But can you tell me, if you've been at your rental location for 5 years, can you tell me, is the rent still the same after it's been 5 years? You can assume so that it will not be, because maybe the landlord's like, you've been here long enough. I know you have money, so I'm going to charge you for these and these and these, right? Your rent has increased this month or this year, things like that. So a fixed expense can actually turn into not a fixed expense. So here's the assumption that your expenses will never be the same every month. Same thing, right? When you're having advertising expense, are you going to advertise every single month? Some months you will, some months you won't. So the main concept is that you're trying to close them out. Now the question is, how do you close them out? Straightforward answer is you're zeroing out every single account. That's how you close them out. You just zero them out. So as we all know, revenues typically have a normal balance of credits. So in order to zero out a credit, your simple answer is you're going to debit the account. So you're going to be debiting all of your revenues, okay? For your expenses, you're going to be crediting all of your expenses. And where are you going to be placing them all into? We have an account called income summary, all right? For sole proprietors, we use income summary. For corporations, you can understand this as returned earnings. Oh, I'm sorry, retained earnings, not returned earnings, retained earnings, okay? Now, because we're looking at sole proprietor only, I just want to make sure that if you do go into a company that uses retained earnings instead of income summary, they are essentially the same thing, okay? So we're going to debit all of our revenues, zero out all the accounts, and we're going to debit them to our income summary. Our expenses are going to be credited, zeroing out every single account into the income summary, all right? Once we've completed that, your last thing you have to do is you're going to have to zero out your income summary into your equity, okay? So in this case, here's an example, right? I debited all my sales, I credited all my expenses, and now I have a positive number in my, or a credit in this case, in my income summary. So I need to zero out my income summary by debiting it and crediting it into my equity account. Okay, so it's going to be dependent on which side your income summary is. If it's on the debit side, then you need to credit it. So you're going to actually be subtracting from your equity. And if your income summary is a credit balance, you're going to debit the account, which is going to increase your equity, okay? And we'll take a look at how this works when we actually complete our coffee cafe, okay? Now, of course, this is another journal entry because if you're looking at our coffee cafe, how many accounts do we have that's involving our sales and involving our expenses? We have quite a lot. So, You can always fat finger some of these numbers in there, and you can also accidentally, transfer the information in the wrong side. So definitely the one thing that you're going to do is at the end of the day, the equity or the amount in your income summary will reflect the number that you've calculated in your income statement. Okay? And then, of course, we also have to, the very, very, very last thing is if there's any capital contributions or any owner's withdrawal, you're going to close that out to equity as well. Okay? That's the other last thing that you need to do. Okay? So to close out the books, we're going to debit our revenues, credit our expenses all into income summary, and depending on what position your income summary is, whether you need to debit or credit the account, you're going to close it out into equity. All right? And then anything else that comes after is closed out to equity. Okay? Once you've done that, then the last thing you have to do is make sure that you did your accounting correctly and that you journalized everything by making sure that you complete one last final trial balance called the post-closing trial balance. Okay? Making sure that your debits truly match your credits. And if they do, your whole entire closing process is complete. And you can file this away and start a new month. Okay? So, any questions in regards to how the closing process works for Chapter 13? All right? The only exercise you have for Chapter 13 is going to be Coffee Cafe. Okay? Any questions?
I have nothing yet.
Okay. Here I give you a little review on the last 6 steps of the accounting cycle. A few things here is the trial balance, right? The main goal of the trial balance is to make sure that your debits match your credits. When we close out our books, you want to make sure that you debit, again, your revenues, credit your expenses, and then you zero out into equity, right? Here's a little overview of each statement. Okay, so first one comes first is your income statement, right? And those are the necessary steps that you need to take, right? Then you're going to complete your statement of cash flows. Number 3 is your balance sheet. And then number 4 is going to be your statement of cash flows. And here is a few ideas of what adjustment entries look like. Okay. Other than that, that is it for Chapter 13. And you do have a quiz on Chapter 13 and Chapter 12. So if you need a quick review of Chapter 12, please do so before you take the quiz. Quiz is already up. It's available now. And you have till Sunday to complete the quiz.